Testing.
Okay, I just wasn't close enough to it. I will wait until. Okay. Hello, everyone. My name is Chris Phelan, and I am the interim director of the Heller-Hurwicz Economics Institute. The Heller-Hurwicz Economics Institute was created in 2010 with the mission of building a bridge between leading-edge economic research happening on campus and the business leaders, policymakers, government officials, and community members who can benefit from that research. We fulfill this mission through events like this roundtable today, strategic communications, including our office hours podcast. It's really good, listen to it. And policy briefs and investing in rigorous research done by top University of Minnesota economists and students, all with the goal of influencing real-world economic policy decisions that promote the public good. We're excited to welcome you to our fall roundtable event tonight, which promises to be a very engaging conversation. We are joined tonight by economists, policymakers, education experts, students, faculty, and community members. Along with those of you in the room, we are joined by many guests tuning in virtually. Thank you all for being here. So tonight's topic, who cheats on taxes? A discussion on tax compliances in U.S. private businesses and why it matters for more than just tax revenues. As our title indicates, who cheats on taxes matters for more than just revenue collection. Tax records are also a great source of data. We can see exactly from tax data, for instance, how much income inequality there is and how has it been changing over time, but only for reported income. By its very nature, reported income data doesn't tell us about actual income inequality if the reported income differs significantly from actual income. For instance, if it's mostly the rich who cheat on taxes, then actual income inequality will be higher than reported income inequality. If it's mostly the non-rich who cheat on their taxes, then actual income equality is going to be lower than reported income equality. And this is but one question where getting a handle on who cheats matters. So to help us to get to the bottom of these issues, we are thrilled to have two very distinguished scholars with us this evening. The first up is my economics department colleague, Anmol Bhandari. Anmol holds our department's Carter Schwab Professorship in Economics. He's also a consultant at the Federal Reserve Bank of Minneapolis and a research associate at the National Bureau of Economic Research, as well as an editor of the Journal of Political Economy, Macroeconomics, and has served as president of the Minnesota Economics Association. His research centers on public finance, asset pricing, and quantitative macroeconomics. Our second speaker, Dr. David Splinter, is a senior economist at the Joint Committee on Taxation of the U.S. Congress. For over a decade, he has estimated the revenue effects of policy changes to immigration, payroll taxes, and child tax credits. His research focuses on income inequality, income mobility, and tax progressivity, and recently the distribution of COVID relief and progressive wage recovery. Thank you to both for joining us. We'll start with Anmol, followed by David. Anmol.
Hello, everybody. My name is Anmol Bhandari. I'm very happy to be a part of this roundtable on who cheats on taxes. So I'm going to talk about tax compliance from a macroeconomist's perspective. And my remarks will broadly cover two topics. Michael. Yeah. My remarks will broadly cover two topics, measurement and the theory of tax compliance. So in the first part, I'll go over briefly some patterns about tax compliance, both aggregate and individual level. David, who is a leading expert on measurement, will talk a lot about that. And in the second part, I'm going to discuss how these patterns guide us towards a quantitative theory of tax compliance, which we can use to study policies related to tax compliance. Okay. So before I start, let me do some bookkeeping for the U.S. for the US government. What do we spend on and how much do we bring in? I'm going to take 2018 as an example year. It's kind of a normal year before COVID, but also the latest year for which we have data on aggregate mismeasurement of income. But this is going to be illustrative for other years too. So in 2018, we brought in 5.6 trillion in tax revenues, and the US government spent 6.7 trillion, which means we had a deficit of $1 trillion. Now compare this to the amount of untaxed business income in the US. It is basically on the same order. So untaxed business income for the US for 2018 was about $1 trillion, which is roughly the same as the deficit which the US government ran. Okay. You can most of the untaxed business income, it turns out, comes through pass-through business income, so about $700 billion of it. And you can look at these numbers also as a fraction of GDP. So the deficit was minus 5.4%, and the pass-through income contribution of that was pass-through income was untaxed was about 3.4% of GDP. Okay, so the point of these numbers is that these are big numbers, and it has prompted a lot of public debate about tax enforcement and also discussions about more funding for the IRS. We saw something concrete when the Biden administration passed the Inflation Reduction Act, in which it had about 80 billion furthermore allocated to the IRS over 10 years, which effectively doubled the IRS's enforcement budget. So this is the background in which I want to discuss our research. We are interested in policies like these. Are these effective? Are there other policies? And our reading of the literature is that, and the state of knowledge on this topic is that both measurement and theory are lagging behind. And that sort of sets us up for a research goal. We want to update both of these. And part of this work is done with collaboration with the IRS, which is going to help us achieve these goals. Okay. So the way I want to organize the rest of the talk is that first I'm going to give you a little bit of a summary of what private businesses do in the US, and some details about their compliance, and then talk through how we then model them and use the theory. So in the last 40 years, there has been an interesting change in the landscape of business income in the US. In the 1980s, so this is a graph which looks at the composition of business income by different types of businesses. In the 1980s, if you look at the leftmost side, what you see is about 3/4 of the business income came from C corporations. Mostly these are large listed corporations, although not all of them. Not all of the income comes from them. There are also privately held C corporations, but primarily the big part of the green thing is publicly listed C corporations. As time goes by, currently, what you see is a big decline in the share of incomes from C corporations, and that's offset by increases in business income from sole proprietors, partnership, and S corporations. These three together are called pass-throughs, and that's a significant change. What it means is that more than half of the income now comes from private businesses, mostly pass-throughs. These businesses are complicated by their nature. We know little about them, but they dominate the discussion of inequality, tax policy, business dynamism, and so on and so forth. It turns out that because we know little about them, there are conflicting narratives about what motivates them, what do they do. So in some of our current work, we have looked at the first two bullet points: what drives entrepreneurial activities, how much they earn, so on and so forth. Our current work is going to focus on how they cheat, how much they cheat, and what we can do about it. Okay. So before I get into the compliance, I'm going to flag a couple of topics, or at least concepts. I'm going to be brief over them, partly because David is going to talk about them in much more details. But basically, whatever we know about the compliance comes from audit data. And there are two types of audit which the IRS does: operational audits, which are done in the regular course of business, and random audits, which are done to estimate the tax gap or to correct for national accounts. So the random audits were the random audits have a long history. They were known by Taxpayer Compliance Measurement Program (TCMP) in the old days, and currently they are done under the National Research Program. It turns out that just doing random audits is not enough. These audits are not the sample sizes are not that large, especially given the funding the IRS has for them. And there's a ton of adjustments which are done beyond the random audit. And there are a lot of interesting details which are buried under these adjustments. But for now, I want you guys to take away this idea that the IRS does random audits plus some adjustments, and this is the source for estimating the tax gap. How much taxes are we missing? Okay. So based on their calculations, let's look at the numbers a little bit more in details. So this is across time, and the tax gap is roughly $600 to $700 billion. More recently, about 3% of GDP. Okay, if you break down this tax gap on a broad level, most of it comes from underreporting, and most of that comes from business income. So about half of the tax gap, which is about $300 billion, comes from business incomes. And this sort of should connect to the $1 trillion number I gave in the beginning. If the tax rates are roughly about 30%, if you miss $1 trillion of income, you're going to miss about $300 billion of taxes, which is what this is trying to say. And it's kind of not surprising that a lot of the missing tax or the tax gap comes from business income. There's a simple reason. With respect to other income like wage income, there are, the taxes are collected before before the income comes to the taxpayer, like a W-2 income. When it comes to business income, there's just one-sided. There's no two-sided reporting, and that's sort of the primary reason why most of the cheating happens with respect to business income. Okay. So now I want to get into a little bit, not too much, into how widespread the cheating is, and this is where I'll use evidence from the past NRPs. What I'm going to show you is going to reveal that cheating is widespread with respect in the sense that it happens in all income bins and roughly kind of uniformly. But within each income bin, there is a lot of concentration too. All right. So let me describe what I was trying to say with the help of this graph. So I'm going to rank people by their business income. So the bins here are percentiles. Negative means people who make losses. 0 to 40 means 0 to 40th percentile. 40 to 60, so on and so forth. Right. So this is reported income. And on the y-axis, I'm going to have a ratio of unreported income to reported income. So the sum of how much is missing divided by how much they reported. Okay. So let me start with what we have across years. And I've intentionally left the 0 to 40 thing empty. I'm going to fill it in. But let's just stare at this and look at the numbers. So numbers like 100 or more than 100 roughly mean that the amount you misreport is the same as the amount you report. So about half of your true income is underreported. What you see is that this misreporting is kind of large in the middle, and it somewhat comes down towards the end, but it's still prevalent everywhere. There is also an important thing, which is there's a lot of misreporting in losses. Okay, so these are relatively large numbers. What we can do is so let me put the 0 to 40 here. The numbers go up primarily because we're dividing by a small number. So, a number like 800 or 90 means about 80% of your true income is underreported. So roughly speaking, in terms of fraction in terms of if you think of the fraction unreported, you see high numbers, but declining as you go to the right. We can do something else. We can look inside of each bin, how the distribution of underreporting is what is the histogram or how it's distributed, this underreporting. right? So what I have is that in each bin, we count the number of people who misreported 5%, 10%, like all the fractions. What you see in this graph is that most of, first thing you see is that the 50%, which is like the median, is close to zero in each of the bins, which basically says that in each bin, about half of the people do not misreport. So even within each bin, most of the misreporting comes from the people who misreport a lot, which is basically the orange and the dark red bar, where where most of them where we have the largest misreporting numbers. So the top 15 or 25% of the people, roughly speaking, in each bin are misreporting a lot. Okay. So these two pictures kind of tell us that it's misreporting when it comes to business income is widespread, but at the same time concentrated it's also concentrated within each bin. So when we think about tax misreporting, the first reason, like why do people misreport? The first reason which comes to our mind is, well, we don't audit them enough. So like economic deterrence. While that's kind of important, I want to argue in the next couple of slides that there are other motives which also matter for tax compliance. And these motives I'm going to roughly call as non-pecuniary motive to distinguish them from economic deterrence. It's hard to get information about non-pecuniary motives, but there is some interesting data work by which these are survey data, but they are informative about these. It helps us learn a little bit about these non-pecuniary motives. One of the sources which we use is the Taxpayer Advocate Services. This is sort of a unit within the IRS, and it conducts survey. So one particular survey they did was for sole proprietors, and because they are connected to the IRS, they know internally which of these guys are more likely to cheat, at least from the perspective of the IRS, and less likely to cheat. So imagine like splitting people into groups, or sole proprietors into groups. These are the cheaters and these are the non-cheaters, and they ask them a bunch of questions and compare the responses. So what do we find? So this is comparing the extreme bins, so the lowest and the highest compliant groups. It turns out that both of these groups agree on a bunch of things. They agree that tax rules are complicated. They understand the consequences of underreporting. They profess a moral obligation to pay taxes. Where they're really different is that high compliance people reveal, or at least disclose, more trust in the IRS and the government, and they also rely more on tax preparers. So this also sort of connects a little bit to the previous data where the people with high reported income had lower fractions of misreported income. Okay. So this is sort of the big patterns I wanted to discuss. That the tax gap is large, about 3% of GDP. Most of it is business income underreporting. It's sort of widespread, and economic deterrence is just one of the factors which drives compliance. So given these facts, I want to kind of assess where we stand in terms of theory and what we are doing from our side. So it might look surprising but it's kind of true that most of the work on tax compliance still is based on a paper from 1970s. And this is a paper by Alling and Sandmo, which was very influential. And what it did was it basically laid out the language for us to talk about tax compliance. It was a basic model of tax compliance where the gains from cheating is the taxes you save, and the cost of cheating is the probability of being audited. So there's a static trade-off between these gains and benefits, so gains and costs, which determines how much you cheat. Now, while this paper was important in terms of in the sense of putting this as an economic deterrence model, it is not enough to help us with kind of the questions which we're interested in. which is what happens when we think about big changes in our enforcement regimes. What we need is sort of a macroeconomic framework which allows for dynamic considerations. When we think about the problem of a business owner, it is not just static where he just compares cheating versus not cheating. There are other issues which come in. And I'll speak a little bit more about that on the next slide. But in addition to that, we also want to incorporate these non-pecuniary motives, which I discussed before. And finally, we don't want to think about tax cheating in isolation. We want to think of it as a module in a fuller model of the economy, because we want to think about, when we do these big changes, we want to think about margins on which the economy can adjust in the short run, in the long run, and so on and so forth. So we need a macroeconomic framework which is fit for aggregate analysis of the type we are interested in. So to address that, what we did was we sort of went back to our previous work and build upon it. So in the previous work with Ellen, we worked on U.S. private businesses, and we built a model of individuals who are heterogeneous in their skills with respect to working for businesses or working for themselves or working for some other people, and they could choose their occupation. So there was transitions in and out of paid employment and self-employment. On top of it, there was accumulation of financial capital, as well as what we call sweat capital. And by that, I mean capital in the form of client list, brands, so on and so forth, or business capital. So we use that model in that paper to get a sense of how important sweat capital is and how it matters for business taxation. What we do in our current work is we sort of extend that model to allow us to think about tax enforcement. And the way we extend it, there are a couple of ways in which we extend it. First, besides skills in running businesses or working for others, we introduce another type of taxpayers meant to capture this non-pecuniary motives we saw before, where we think of people as compliant or not compliant. Okay, so the way we think about it is that you could be productive in terms of you could be good at running your business, or you could be good at cheating, and these are different attributes of a person. So we incorporate that. The other thing we do is we allow for a margin with which individuals can cheat in their businesses. And this is, again, motivated by the fact that most of the cheating goes on in the businesses, in the activity when you run your own business. And so we want to have that margin. The way we think about it is, broadly, you could underreport your revenues or overreport your expenses. It turns out this distinction is sort of not that important, but you need some kind of action which you can take to lower your business income. So the model already has a bunch of dynamics of people going into and out of businesses, but there is an important aspect of dynamic consideration when it comes to tax evasion. So beyond the static fine which you might pay when you get audited, we think of other things which could happen when you're caught cheating, like your loss of reputation, you lose your customers, business brands, and so on and so forth. That's kind of the forward-looking part. There's also an important backward-looking aspect, is that the IRS does not audit you all the time, but when it audits you, it can go back and look at your past returns up to a point. So in that sense, we need to keep track both of not just current cheating, but also cheating which is done in the past, because that forms the basis for your fine. So once we incorporate all of these features, we sort of get, and I'm not saying this is perfect, but we sort of get the kind of model we were expecting for, which we think is at least a starting point to start talking about big policy changes. Right? I'm not going to lay out the equations which underline all these words. We have a paper. I can circulate the link, which kind of goes into the details. But I want to share some results from this framework. So here's one thing we did. So imagine you want to raise certain revenues, and you think of two ways of raising money. One is you make enforcement stricter, so you hire enforcement, or another way is you increase taxes on business. So these two, we kind of calibrate these two avenues where they raise the same amount of revenue, but just in a very different way. And what we do is, from the lens of using our model, we look at outcomes, like what does each of them do, where they're similar and where they're different. What we find is that both higher enforcement and higher taxes lead to fewer businesses. And that's kind of intuitive. Both of them are, in some sense, a tax on running a business. In fact, we find that the higher enforcement leads to fewer businesses than the higher tax rates for the same amount of revenue. But they're also different in some key ways. One of the key differences is the composition of the tax base for business owners. So remember when I described the setup, individuals are different in two dimensions in terms of how good they are at cheating and how good they are at running businesses. In a world of law enforcement, you can imagine what happens. You have a bunch of people who are running businesses because they're good at cheating, and not necessarily because they are good at running businesses. When you increase enforcement, you are basically imposing a tax on these people. So what you get is a change in the composition of the tax base, where you have now more productive and or on an average, you have more productive in terms of running their businesses people as a composition of who pays business taxes. The other thing this policy experiment does is that changes the type of capital which you accumulate. So in a world where you're cheating, where you have a bunch of cheating done in the past, there's always this big risk that you might be audited, and you need to save in response to this eventuality, which means that a lot of resources are stuck in what I called initially as financial capital. When you do higher enforcement, there is less cheating, so less need to keep this financial capital, and you kind of invest more in business capital. But on a broad level, what these counterfactuals allow us to do is we can test things like IRA. And what we find, at least at the current, what we have right now, we find that policies like IRA, Inflation Reduction Act, they can be effective. So in the example in the simulations which I was describing, enforcement costs go up by $5 billion. So this is less than the $8 billion, partly, but this is kind of the right number for us, because a part of that $8 billion is for people who pick up phones. So if you think about pure enforcement, that number is more like $5 billion. So you can think of this as replicating, roughly speaking, the size of the IRA. What we find in our model is that tax revenues go up by $20 billion a year. So it's about $4 or $5 for every dollar you spend. These numbers are in line with other estimates people have put out there, and at least in a world where audits are very effective, which is something we can talk about in the discussion, but in a world where audits are effective, you can raise money from higher enforcement. All right. So I'm coming to the end of my talk. I want to summarize the key takeaways. So tax evasion is large, it's widespread, and at least in our opinion, understudied. Business owners are the major source of tax evasion. And what we are doing right now with the IRS is we kind of trying to link the stuff on evasion with the stuff on business owners, so we can kind of track people both pre and post audit to learn better who cheats and what are the consequences of cheating. Because at the end of the day, those things are crucial for thinking about the effects of this policy. I mean, there are other things about, short-run effects, long-run effects, and welfare, which we want to work on. Right? I'm done with my talk. I found this quote in a book by Joel Slamrod and Mike Keene, which I thought was hilarious. So I'll leave it up. You can read it. But thank you.
Okay, is this on? Great. Okay. So, you read enough of Mark Twain? Those extra slides? Yeah. Am I going backwards? There we go. Okay. So this is some joint work with my colleagues at the Joint Committee on Taxation, William Gorman and Jamie McGuire. Quick disclaimer, these are my own comments, not those of the Joint Committee or any member of Congress. For those not familiar, the Joint Committee is because we work for both the House and the Senate, and we're most known for providing the official revenue scores for proposed changes in tax policy. To do that, we use a whole lot of tax data, and I'm going to be showing you some analysis from some really big populations of tax data and also the audit studies that Anmol was mentioning earlier. Okay, I'm going to get this direction right. Okay, so the IRS has been doing the studies since the 60s, like Anmol said, and basically they keep coming up with nearly the same outcome. And that is that the voluntary compliance rate is around 83%. It's jumped recently to about 85%. And then in 2021, what he showed you were actually forecasts. That's why those numbers were exactly the same in 2014 and 2021. But in 2015, there's about $500 billion of estimated unpaid taxes by the IRS tax gap method. And that's out of 3.3 trillion of true taxes. You divide those two, you get a 15% non-compliance rate. And that's what we're really going to be breaking down in this discussion, trying to understand who are the people who are composing this, what kind of income it is it, and where in the income distribution does it lie. So the official kind of IRS estimates rely on a whole lot of work. These don't just come out of nowhere. These are based on a lot of information and a lot of auditors' work. And these are basically real audits that I'll describe a little bit more. But they're not going to provide you any distributions in the official tax gap estimates. And so that's what we're going to provide here as a new contribution. We're also going to discuss some of the limitations of these tax gap estimates and also the macro implications. So the special audit studies, the NRP, as they're known as now, they, as you've already seen, find widespread noncompliance among about half of tax returns. And this is largely in these pass-through businesses, in particular sole proprietorships. That's Schedule C on your tax return. And what we find with these audit studies is that the income distribution becomes slightly more equal when you add this underreporting. So that's addressing the setup that Chris had at the beginning of the presentation. Okay, now what we're going to do is we're going to use those audits to estimate the gross tax gap for filers. We're going to add in non-filers, corporate taxes, estate taxes, and also underpayments. And then we're going to get to a net tax gap by deducting late payments and the effective audits. As you can see here, the effective audits is not particularly large. That's because we don't do many audits in the US. We'll also find that the non-compliance rates are the highest at the bottom of the distribution. And this is similar to what other papers have found that have either looked at both either the underreporting income or just a portion of the tax gap. What we're going to do is look at the full tax gap. Okay, so these operational audits are kind of like the normal setup. If you get audited, you're going to be selected based on the likelihood of noncompliance because IRS has limited resources. So they want to target those returns that are most likely to have underreporting. And they're only going to look at the lines of your return that are the ones they're going after. The random audits, in contrast, are going to basically randomly choose people. They're going to oversample people with high incomes, and they're going to go line by line throughout your whole return. So these are very frustrating kind of audits to go through, but they're very helpful for people who want to understand noncompliance. The numbers that come out of these are going to include every change that the auditor thinks is appropriate. This is even if it comes out of an accidental error by the taxpayer, just because they had a missing document and they're going to have a deduction rejected, or when the rules are uncertain, which is the case for a lot of business tax rules. It is not estimating technically evasion because this isn't estimating the intentional kind of noncompliance. This is just what the auditor thinks is the difference between what the person reported and what it should have been. Okay, so this is basically the same as what Anmol showed you. There's about 9% of people who are found with the auditors to overreport their taxes. About half of people have no adjustment, and about 44% have a positive adjustment. And of those, about a third have at least $100 of their taxes go up after this audit. Okay, but this is still not telling you much detail. How is it distributed over the age distribution? Well, it's pretty proportional. the age distribution. That's the blue lines is the share underreporting, the orange is the share of the population. So in every age group, in every income group, there's going to be some underreporting. On the right, there's, like Anmol said, there's this large tail of people who are doing a disproportionate amount of the underreporting. There's a 10% of people who are basically only paying half of their taxes. And there's some people that are only paying a third. That's that 5% at the very end there. Okay, so what kind of income is driving this non-compliance? At the very top, you have the most non-compliant in 2001 was farm income at 72% non-compliance rate estimated. But the blue line shows you how much that contributes to the tax cap. And it's not very big because farm is just not a big part of the US economy. Below that, you have the next most non-compliant source, and that's for sole proprietors and also their self-employment taxes. And to some degree, the next group below that, which is non-filing. A lot of that is due to self-employment. So at least 40% of the tax gap is coming from these sole proprietors, and they're really driving a lot of what we're seeing in these audit studies. For the more than the average or less than average non-compliance rates, you can see partnerships, S-corps, corporate taxes, capital gains, deductions. So larger businesses tend to be more compliant than these sole proprietorships, according to these studies. And also capital gains, are something that are now reported on 1099s pretty well, and so they're going to be covered with that information. Okay, as you've heard, we're going to scale up the amounts of underreported income that the auditors detect. And the way the IRS is going to do this is with a process called detection controlled estimation. And what they do is they compare similar returns and they bring the less aggressive auditors' adjustments up to the most aggressive auditor adjustment within those kind of group. Now, what this is going to do is it's going to triple the amount of undetected income. So in 2015, they detected about 400 billion of underreported income. They're going to add another 800 billion. So that's $1.2 trillion of total being added according to these studies. As far as the taxes, they only double so they start with 150, and then when you add this other income, it's going to nearly double with 130 more. Okay, so how do you actually implement this with the data? With these DCE, you need to have some multipliers where you're going to scale up the detected amounts of underreporting. The old method was to just proportionally scale up everybody with really similar kind of multipliers. But this will give you an incorrect distribution. And there's a lot of people who criticize this. So the first quote here says that these multipliers were applied to all auditors, regardless of the skill. And that runs counter to the intended application of the adjustments, which is to scale up the less aggressive auditors more than the most aggressive auditor. Okay, so what Jerry Otten and I developed a new kind of multiplier method called distributionally consistent multipliers that are going to try and do this to some degree. Okay, so this is just a hypothetical example. Let's say you have 4 auditors going from the least aggressive on the left, who only detects about $10 of underreported income, and the most aggressive on the right, who has about $100 detected. And these are among similar returns. So the simple multipliers would basically just scale these up. And what you see is this person at the right, they already had the most aggressive auditor, but a simple multiplier would then give them way more money. In a lot of cases, what this would do is it would drive them up to the very top of the distribution, even though that's where they probably shouldn't be. So what we're going to do with the distributionally consistent multipliers is try and scale up those with the smaller adjustments more than the one at the top. We don't see the auditor identities in the data we have available, so we're going to have to do a kind of indirect method, but it's going to have the same effect as what I'm showing here. Okay, so this is a similar figure to what Anmol showed. On the left, we have negative incomes, and then we show the next 4 income quintiles. That's 20 percentiles of the distribution. And on the right, I break up the top quintile into 4 groups. Now, what we're doing here with the gray bars is we're starting with the $10 trillion of fiscal income. That's the income that's reported on tax returns, and we're going to distribute it over the income distribution. And then what we're doing is we're going to add it with the orange lines, the detected underreporting. Now, what this is going to do is it's going to lower the amount of income. Sorry, it's going to increase the amount of income in the negative group, and it's going to lower the amount of income at the very top of the distribution. That's going to lower income inequality somewhat. When we add the undetected amounts, it's going to basically do that again. And so we have a slightly more compressed income distribution, i.e. lower inequality. Okay, now this is what I really want to focus on here, which is how do you estimate the gross tax gap across the income distribution? So what this is showing in aggregate is that there's relatively smaller amounts of dollar of tax gap at the bottom quintile than the top 1%. The top 1% has about a quarter of the total estimated tax gap. Now, I'm going to go through these different colors going from the bottom to the top. So the detected individual income tax, which is the dark orange, that's basically exactly what the auditors find in their estimates. Then when you scale up with this DC underreported amounts, you're going to get this light orange. Those amounts are going to do very little for tax credits. Basically, they assume what the auditors detect for non-compliance for tax credits is about right. And so you don't see much change in the bottom 2 quintiles when you do this DC adjustment, but you do see a very large change in the top 1% because they're subject to the highest statutory tax rates. Now, the blue line is payroll taxes. These are going to mostly be in the middle of the distribution where most of the wages are. And also a component of that is SECA taxes. And then for non-filers, these are going to be in the middle and bottom of the distribution. And then for corporate taxes, they're going to be disproportionately at the top of the distribution. What we're doing here is we don't really know who owns corporations in America or who bears the incidence of the tax. And so what we're doing here is following the kind of standard assumptions that labor bears about a quarter of the incidence, capital bears 75%, and among that capital, a lot of it is held by retirement accounts. And then the rest is held by mostly rich people. Okay, and then finally, some people fill out their taxes correctly, but then they don't send the check to the IRS on time. And so this gray line of underpayments is representing these people didn't have non-compliance in the typical sense that they underreported on their tax return. It's just, they just didn't send the money in. And then there's a small amount of estate tax that we allocate to the top 1%. Okay, so now that you've got the gross tax cap, you want to get to the net tax cap. So how much money, after we've done a little bit of enforcement, after we've given people a few months to pay their taxes late, and after audits, we can lower the tax cap by about 2 percentage points. And so you can see these late payments in gray are mostly offsetting the underpayments in gray above. And so basically most of the kind of late payments, they come in, sometimes with nudges from the IRS. And then you can see that audits in purple are basically not doing much to close the tax gap. Okay, but so you've seen that the absolute dollar amount is mostly concentrated at the top of the distribution when it comes to underreporting and noncompliance. But to get a kind of noncompliance rate, you need to scale that by the amount of taxes that people pay voluntarily. And so what I've done here is I've stacked these gray lines on top, which is how much they pay voluntarily. And now what we're going to do to find the noncompliance rate is we're going to divide that gross tax gap amount by the total amount, which is what the IRS would consider the true tax liability for each of these groups. Okay, and when you do that, you get the noncompliance rate for each of these income groups. And you can see that the bottom 2 quintiles have about twice as much noncompliance, and everyone else is about average. The way that everybody else can be about average is because this is based on dollars, and most of the dollars are at the top of the distribution. Obviously, what we've done here is we've divided, a modest number by a small number, and that gives you these large non-compliance rates at the bottom. Okay, but we're not the first ones to show something similar. Other people have looked at a portion of the tax cap, the individual income tax component of it, and they find the same kind of thing. Over the income distribution in 1988 or in 2001, you're going to see the highest non-compliance rates at the bottom of the distribution, and then about average for those in the middle and all the way up to the very top. Okay, so what about the limitations of these studies? There's definitely a lot of limitations. Guyton et al. Have shown that in the mid-2000s, there was basically very little of offshore income reported or detected by the auditors in these audits. And they can do this because we had FBARs, which was this kind of data sharing agreement that came in to effect. And then you can go back and see, did the auditor actually find that income? And in most cases, they didn't. However, it represents a pretty small portion of the tax gap, even if you added it in. And in recent years, there's been a lot more enforcement and with FATCA. And so that's probably declined by about half or more since 2014. The other big question is wondering if there's sufficient coverage of pass-through business underreporting, especially for S-corps and partnerships at the top of the distribution. My read of the data is that the audit studies probably are not missing that much pass-through income. And one of the best sources of information we have on that is an audit of the audit that the IRS did. They did a special S Corp study where they looked at the S corporation entities, and they were looking for it was basically a special audit of them. And they found that no additional adjustment was needed for the audit studies for Schedule E, which is the partnerships and S Corps. Basically that with DCE, they were detecting enough non-compliance. Also, just recently, the IRS doubled the audit rates from 4 to 8% for people with over $10 million. And they said, we're going to stop this program and these high audit rates because they weren't finding much underreporting. And so they went back to about 4 or 5%. Also, when large partnerships are audited, which doesn't happen that often, it results in average income decreases, not increases. And so, yeah, it is a bit surprising, but they're not finding much income there. Now, there are some limitations that I think are worth recognizing, especially for an audience interested in macroeconomic data. So this audit-based underreporting represents about 5% of GDP in the official statistics. But there's many reasons to think this may be overstating the amount of income that should be in GDP. So in operational audits, half of the recommended additional tax is disputed by the taxpayer. And then in the end, most of that disputed amount is actually abated by the IRS. So it doesn't get paid. The IRS basically gives up. And part of this is because there's many gray areas of taxes. It's unclear. And so it's basically what the IRS says versus what your tax preparer says, and they're going to hash it out. And eventually, you might pay less than the auditor originally said. The other question is if the DC tripling of detected underreporting is too high. This might be the case because it's based on the most aggressive auditor, not the most accurate auditor. We don't know who the most accurate auditor is, but the tax gap is based on just an upper bound of what might be the amount of missing taxes. And you can see this when you look at international comparisons. Our tax gaps range between 15 and 17%, but other Anglo countries with similar tax systems range between 6 and 11%, so about half or a third of ours. If you take out DCE, the US tax gaps falls to something that's much closer to theirs, about 10%. And so it's worth thinking about what does the tax gap actually represent? And the 16% estimate is basically if we had the most aggressive auditor auditing almost everyone in the whole country. So that's kind of an infeasible threshold. The 10% is if we had our actual auditors auditing everybody. But given that a lot of these taxes are abated, maybe 7% is a more kind of reasonable upper bound of what we might expect. And even of the people in operational audits who aren't abated, a lot of them don't even pay the taxes. About a third of the taxes don't even get paid, even if they weren't abated. So, it's probably closer to something like 5% in actuality of what the actual recoverable tax gap might be. Another real big concern is that some of the most volatile income is this underreported income from these pass-through businesses. And they make up about a third of the income in GDP for those for proprietor income. And they're not based, these audits only come out 7 years later. And so when we're looking at like in the middle of a business cycle, they're going to use some prior year interpolation for that income. So they're smoothing out in national statistics what's going on with this income. Okay, so I just want to end with a quick puzzle. So this is from 2000 to 2015. You can see in the second half of this, from 2009 to 2015, the audit rates went in basically a half, from about 1% of returns being audited to about 0.5% being audited. But at the same time, the compliance rate after audits went up 3 percentage points, which is a massive increase given how stable it was over the last 60 years. So what is going on? How can audits be going down by half and compliance be going up? Well, the issue is, and this is why the Aliman's Sanmo kind of like model frustrates me. It's like, it's not about audits. There's a lot more going on that determines compliance than just the rate of audits in the economy. And a lot of it is, how can we make your income visible to the IRS? And the way we do that is with third-party reporting. That has increased significantly in the last couple decades. We see a lot more gig transactions with 1099s. We have a lot better idea what your capital gains basis is. And we have a lot better idea of what your offshore income is. Also, people have moved dramatically to electronic filing, and it's much easier for the IRS to kind of work with the data if it's electronically filed. Also, they can reject your return if you electronically file if they see something amiss. And so that's basically keeping bad data out of the tax gap even before it gets in there. So one example is if you try and claim a child that's already been claimed, they're just going to reject your return. And there used to be about over 1 million kids that were claimed twice by 2 tax returns, and the IRS would just send checks to both people for the child tax credit. So, but it's mostly been stopped because of the rise of e-filing. So it's kind of an indirect way, which doesn't require audits, to actually increase compliance. The other, also the IRS has more math error authority, and this is when they basically just correct a number that they know is wrong on your tax return. So a lot of people didn't know how much stimulus checks they got. The IRS just went in and overwrote about hundreds of billions of dollars and corrected those numbers because they knew exactly how much they sent you. Also, there's a lot more oversight of paid preparers. Okay, so the main 3 conclusions I want to leave you with is that there appears to be widespread estimated tax noncompliance, probably with half of tax returns possibly being noncompliant, but this is in the most kind of aggressive and broad definition of noncompliant. 44% of tax returns have some kind of tax adjustment. An additional 6% of people with no adjustment don't pay their tax bill on time. But this is mostly concentrated as far as the dollars go in sole proprietors. And the noncompliance rates are about twice the average at the bottom of the distribution, about average for everyone else. And also, audits are probably overrated to some degree. They have little effect, only closing about 2% of the tax gap. But the numbers that Anmol showed you that they could raise, with additional funding, another $20 billion, that's probably right. But it's still, what would that be? That would be another 4% of the tax gap it would close. So, I mean, it's still got a long ways to go. Also, the tax gaps rely on these really strong assumptions, especially the tripling of the detected underreporting with the DCE. It's just something that I'm not aware of any other country using for their tax gap estimates. Also, there's no correction for these kind of what might be thought of as overly aggressive or disputed adjustments to get us to what we might think is a truer kind of sense of the tax adjustment that's needed. Instead of just going with what the auditor thinks. I mean, this is really hard. Like, how many auditors of the audits can we do to figure it out? But one way to do this is, it'd be nice to know the range of noncompliance detected by auditors of similar returns. We don't know what the median detection is relative to the most aggressive. And if we had those 2 moments, I think we would have a lot better idea how much more aggressive one is relative to another. Also, this could potentially bias GDP levels and to some extent business cycles. Okay, I'm there.
Microphone. Okay. Have a seat. Is this on? Okay, that was fascinating. I want to use my prerogative for the first question, and that is what I like. I always call it the Willie Sutton question, which was Willie Sutton was a bank robber who was asked why he robbed banks, and he said because that's where the money is. So there's kind of 2 reasons that I could think of to care about how to get better tax compliance. One is just fairness, which is I don't want those bad people who aren't paying their taxes when I pay my taxes, as far as you know. I want the people who aren't paying their taxes to pay. But there's also, I just want to raise money. So what are your guys, do you see a trade-off there? And just also, where is the money to increasing enforcement? Is this a big deal? Should we worry about it?
Yeah, the rate of return of being about 3 to 5 times on spending on enforcement, I think is about right. That's been consistently shown. So if you want to raise revenue, that overall is what you're going to get, but you're going to get blowback. People don't like being audited. People don't like having their refundable tax credits denied. There's also a disparity in what is cheap and has the highest rate of return. Tax credits, not every audit is an in-person audit, which are expensive and time-consuming, sometimes don't raise any money. So the other thing that the IRS does in a much larger number are correspondence audits. They send you a letter, and if you don't answer, they might just not send you your tax credit. And those can be problematic because maybe the person moved and they can't get in touch with them, but they're very cheap. And so if you want to raise revenue, they're great. but they're not going to hit where the money is. The money is at the top, potentially, but it's harder to get.
To add one thing, so a world where you have more enforcement also means that you have a broader tax base, which is often useful in the sense that the cost of raising taxes is often, if you want to raise some money, it's good that you raise it from a broader tax, but you have to raise in percentage terms smaller, which is often less costly to do. So eventually, if we are looking, for higher tax revenues in the long run, it's better to have a broader tax base, which I think we get by enforcing taxes.
So is one of the lessons from enforcement that I thought I learned at the end was non-audit ways of getting enforcement, which is like now when you sell stock, a 1090, they know what your basis was. They know what your capital gain is. And so you don't have to rely on my record. Is that the future?
Technology is going to change, and that's going to change the way IRS collects taxes. I mean, the biggest improvement in terms of compliance came when we started withholding taxes for payroll. That was like by far the biggest increase in terms of tax revenues collected. It's kind of surprising that the US has limited withholding outside of payroll taxes. It's virtually, except for some foreign stuff, we don't withhold much taxes. But one lesson for me is either third-party reporting, which comes through things which the IRS is doing now, or some sort of withholding of taxes will just automatically will help in collecting more taxes.
Okay. So I guess now's the time we want to get questions from the audience. How about, I'm the interim director. I'm going to actually ask the director. Do we have a?
Okay, and so, you guys are very focused on how do we get enough tax revenue? And if you think about one lever, how do we increase the tax compliance with having more audits, say? But what about changing the system just to make it, imagine we change the tax code to make it harder to evade. I mean, David mentioned kind of third-party reporting. And as a foreigner, to me, the tax code is super complicated compared to so Scandinavia has figured it out. If you want to have high taxes, the tax code has to be super simple. But so just as an example, you showed that almost all the lion's share of the missing tax revenue is from business owners or sole proprietorship, as opposed to corporations. Why couldn't we just tax sole proprietorships like corporations? Wouldn't that just solve the problem?
Yeah, changing the name is not going to solve the problem. There's consumption taxes are clear because there's a clear transaction at a clear price, and we don't have a VAT. If you have an income tax, then there's always going to be the problem. And you have a business, what is a personal consumption expense that's non-deductible, and what is a valid business deduction and business expense? And that's really what these debates are about. I mean, there's obviously hidden deductions that can happen in a C corporation, a sole proprietorship, a partnership, anything. But there's just not clarity in when you're spending money in a non-consumption tax world, and what is private consumption and what is an expense for the business. And I think that's really where, so for among the sole proprietorships, over 2/3 of the corrections of income are coming from excess deductions that are denied by the auditor. And so this is really a question about paper trails for spending on the business side.
I kind of agree with that. Yeah. In other countries, maybe in Scandinavia too, with value-added taxes, there's actually a chain of transactions, and there's if you have invoicing which is electronic, you can follow this chain, and that gives you automatic ways in which you're going to enforce payment of taxes, because the other guy has to ask for a refund. We don't collect in the US that much revenue from value-added taxes. So it is a good question and a broader question of, if we should be changing that. I think most economists would say that it's a good idea to go to something like a value-added tax. But yeah, I don't.
How about the red shirt right there?
So yeah, what are the incentives of these people just on with negative incomes to hide their incomes? If they report, are they just not filing at all? If they reported their incomes, could they write them off in the future? Anything like that? And then also, how has the effectiveness of audits changed over time? And you touched on that when you talked about the offshoring, but have there been people that have learned to avoid audits or avoid their income being found by audits?
I mean, the second question is really hard to know, because the audits are when we try and find out, and if they're avoiding that, then I mean that's why I harped on the information returns so much, and that's why the international crackdown with FATCA was just so draconian from a point of view of foreigners, in that having a bank account abroad as an American is kind of tough now, because there's so many reporting requirements. But that's kind of what it took, something pretty strict. As far as the negatives, you're right. If you claim a current year loss that's really big, and you don't use all of it to offset your taxes, you can have a carryover net operating loss in some cases. And so there still is an economic incentive to have a very large loss. Yeah, it's worth. I think we need to dig into them more, because they're an interesting group.
Yankees cap?
Would be, is it your impression that the national income account, GDP, could be overstated by the amount of assumed underreporting? And have you?
Yeah, I mean, that was the idea I was throwing out there. So I said there's about 5% that's added directly into the national accounts. Of that, 1.5% is actually detected by the auditors, and that's probably correct. And it's probably a little too low, so we probably want to increase it some. So maybe, maybe 1, maybe 2. Too much, possibly. I mean, there's so much uncertainty here. The idea was mostly to let you know that this is what goes into the national accounts, so that you're aware that it's not like everything comes from the voice of God. These are numbers that we make up with our own methods, and DCE is a really odd method, at least to me.
Well, let me ask you a follow-up question. That if the income side's overstated, then that implies in some way the product side is overstated. In other words, the C plus I plus G plus X minus M has to be overstated. And so the question is, how does have you talked to BEA how they where they find the extra product? Or
Right, there's always a residual between the two
right,
methods, the income
discrepancy,
and then the product discrepancy. And there's so many moving parts. It's hard. I don't know if we could isolate this as one of the causes, but it's worth thinking about. And the other issue is it's been so constant over time. We don't have any variation to tease this out.
Tom.
Where my deductions, that's an opportunity for non-compliance, and now with the 2017 legislation, which, you know, a large fraction of the population now are just taking a standard deduction. Is there any evidence that that's helped compliance?
I showed you the 2015 NRP because it was the last large NRP. The 2017 just came out, and it's a smaller size, and so that's just before the 2018 change in law. So we don't know. What we both showed for 2020 and 2021 was a forecast. That forecast, my read of what IRS wrote for it was that the corporate tax rate went way down. So corporate non-compliance should go down, both because of just a mechanical effect, but also maybe on a marginal effect. But I don't think they applied any elasticity. So they probably missed that second effect. The pass-through deduction, one would think, could probably increase non-compliance. So, and then deductions, I had it up there on my list, was a lower than average non-compliance rate. I think it was on the order of 10%. So moving to standard deduction probably doesn't lower the non-compliance rate that much.
Yeah, right there. Other countries in the globe that are similar to us, it's tough to say anyone else is similar, but other than tax compliance in Russia or China, how do we rank in compliance with France, Germany, England?
India. So I think the big differences are, if the way we collect taxes is different across these countries. But my reading, and maybe this needs to be checked, but my reading is that we are not that different from UK. It's about the same. I think we are also similar to Canada in terms of the tax gap. Now, there's a question of different methods used by different people. In terms of enforcement, I think US is particularly different in terms of how less it audits. And also the way in which we kind of enforce audit. Chris mentioned India. I mean, India is, this issue is on steroids in India, collecting tax revenues. But there's something I feel we can learn from India too, because they have been thinking about this problem much more than the US. There are two things, at least I see on the face of it, which I think are interesting and kind of worth thinking about, which are different between India and, or at least India and the US. One is that India, even for the direct taxes like income taxes, India relies a lot on tax withholding. So even business to business payments, if they cross a certain threshold, the payer has to withhold the taxes and then deposit it on behalf of so like your payroll tax withholding, we have withholding for business to business payment. I know there have been discussions about that in the US, and often it gets a bit muddled up with respect to, maybe it's hard to enforce or so on and so forth. But given that we are already halfway there with 1099 NECs and stuff like that, I think withholding is kind of worth thinking about. The other thing where India is different, and Australia is different too, I think, a bunch of other countries have a notion of a mandatory tax audit. So this is similar to the gap audits which we have, but you need an accountant to verify your tax position or the tax liability. This is done for larger corporations. So if you cross a certain threshold, you need an accountant or CPA or a chartered accountant to sign that not your, not just the things you disclose to an investor, but the amount you pay to the IRS. So the IRS enforces those tax audits. Again, it's kind of worth thinking about these things, given the extent of cheating which is going on. Yeah.
So I'm going to jump in with another question because David has a pretty famous paper now recently in the JPE about whether rich people pay their taxes, or if that's part of what it's about. So it's this is off the top of my head. It's the top 1% pay 40% of the income taxes, but that's reported. They of the well, no, of the actual taxes that are paid as opposed to the taxes that are owed. The top 1% of reported income tax filers pay 40% of the taxes. Am I right in saying, you know, that if you ask the median person, they're going to say, yeah, but that's because they cheat. But that's actually not true. It's the barbers and the florists who are cheating, and the lawyers and so forth, who are the lawyers and doctors that the top 1% aren't. That's putting labels on it and stuff, but is that close to being right?
Yeah, the data are suggesting that there's compliance. There's such a large share of people non-complying, and it's about equal over the distribution. That's the way I would interpret those results. The form of non-compliance. Now, why are the non-compliance rates higher at the very bottom? Well, it's very different what's going on at the very bottom. A lot of those are disallowed tax credits. And so you claimed a kid that then the IRS said, you can't prove that's a kid that was at your house for 6 months last year. It's very different than I had a sole proprietorship and I didn't report my income, or I over-reported my expenses, versus you're a corporate you're a C corporation with very complicated issues going on with depreciation and intellectual property and transfer pricing. So I don't think making blanket statements about the different situations is much help.
Regardless of political standpoint, we're in an election now, but regardless of that, I guess everyone agrees that we can discuss how much taxes should be, but at least that people should pay, it should be kind of done in a fair way. If you could say one thing, the simplest thing you could imagine to increase compliance, what would it be? Or to increase, just one thing.
For me, it would be some sort of either third-party reporting or withholding.
I think simplifying the tax code to some degree helps, but that's a broad non-answer. Going back to the kids, so I've been working on the tax credit for over a decade. There is no register of, who's the parent who's taking care of the kid. The states have a lot of information, but the IRS doesn't have that information. And so to the degree, they're starting to talk to each other with certain databases. And so this is another version of data sharing. It doesn't have to be, the third party can be a government in a lot of cases. And the more kind of data sharing we have across governments, the easier it's going to be. So just going, you mentioned, making the biggest one thing we did to make compliance better was we had W-2 reporting to the IRS. The other thing they did in the 50s and 60s is they started doing coordinated audits between the states and the federal government, which really helped target the top of the distribution.
No, funny thing, ironically, the tax withholding for payroll was an idea by Milton Friedman.
David, if you have a sole proprietor at the low end of the distribution and they also have children, can they get a double benefit by underreporting their income? In other words, their income's lower, so they get a higher earned income tax credit?
Yeah, my colleagues, Jacob Mortensen and Andy Whitten, have a paper about bunching. And so that's when you report an income near the point, the kink of the EITC and the CTC that would give you the biggest credit. A lot of those people, most actually who bunch, are sole proprietors who can both misreport their income, their gross income, and misreport their deductions. What they did in their paper that was kind of novel is they showed it's not that people just get close to the credit maximizing, but they're exactly at the credit maximizing amount, like tens of thousands of them, more than you would expect in a random distribution. I think this is pretty clear evidence. People are just kind of using tax software and manipulating the numbers to get to the biggest tax credit. There's also evidence that tax preparers sometimes help with the fudging.
You've talked about the the return on a dollar of for increase in compliance being $3 to $5 range. And you've said it's fairly steady, but obviously there'd be declining returns to that, right? Exactly. So as we have more compliance, so there must be some sort of concept of an optimal level of enforcement that we have. And talk about just casually that, the pushback that comes from increased audits because people don't like to be audited. So what's this? Can you talk a little bit, David, probably the most, about this interface between the politics of it and the optimal level of enforcement that might be indicated by, pushing that dollar value, further down so you keep enforcing until it gets to 1 to 2 or what, as it goes on. So obviously in the more recent history, we've had a political divide on this, in that when there was efforts to increase funding for the IRS, it had a political dimension to it in terms of who was opposed to that. Can you provide a little history in terms of Congress, in terms of their attitudes towards tax compliance as being bipartisan, partisan, and also whether this idea of what the optimal level enforcement might be and how that's communicated in Congress or the discussions around that?
I don't know the long history on the politics of IRS funding. Yeah, but that's really what drives the audit rates. And so, but I can talk about the research. So Jamie McGuire, who worked on this paper with me, he wrote a paper a little while ago about these average rates and also the rate of decline that's expected as you increase the audit rates. He doesn't necessarily believe the results anymore. So there's a paper by Bonning et al. From Treasury and a lot of other co-authors where they've kind of argued that there probably is not much of a decline given where we are now. But I don't think that tells us really what happens when you get above 1.5% audit rates. I mean, that's uncharted territory. I did give you that one example of when they doubled the audit rate from 4 to 8% for the over 10 million. That didn't quite work out. So that's one place where we might know where the declining marginal returns are. The idea from that other paper, Bonning et al., is that there's a lot within the 1 million to kind of 10 million range where there's probably a lot of high rates of return. The other idea I like from that paper is that there's fixed costs. So the IRS has to have a data infrastructure. Part of that data infrastructure is collecting all the data, getting it electronic, and then having a propensity score for who is somebody we should audit who has a high likely to find missing taxes, where machine learning and more information can help that become better over time. I mean, there's just so many uncertainties, but those are, I think, the pieces of the puzzle.
Tom?
Being in compliance, but if you actually dug down, you would see they were hiring all these lawyers and doing all these, loopholes and end runs around the system. So is it the right question to just think about how to set up a system to maximize compliance? Maybe the better question is to think of jointly, not just compliance, but also, these end runs around that are legal, technically compliance, but really just as much a problem.
These questions are kind of related, and I think they're very important in terms of the margins through which taxpayer can respond, outlawyer the IRS eventually. The only way I can see, like, thinking about this, given the fact that a lot of this is uncharted territories, is to think through a lens of a model, or at least try to understand which elasticities are at play here. And maybe there's other countries where these things have been done, and kind of use that. But one thing I agree with both of you, that a narrow view of just looking at how much to enforce or what optimal enforcement is not necessarily the right. There's a bigger question. I think the debate should also include on what we spend the money on. I mean, in some sense, there's a broader question of what are we spending on, how do we want to raise it, and a part of it is how do we want to enforce those taxes. So I agree with that we need to think about it in a broader sense.
Just one or two more questions up there.
Thanks. So because bunching came up, in some of my work, I took self-employed filers and matched them to the ACS and looked at people who were bunching on the tax records were actually more likely to report lower incomes on the ACS. And this is looking at January ACS, so it should line up with the tax year. So these are largely, assuming that they're not incentivized, they don't have no incentive to underreport on the survey, then these are likely people who are inflating their incomes to reach the maximum EITC credit.
Yeah, I mean, I think it goes both ways. Yeah, you can inflate your income to get to the kink, and you can add extra deductions to get down. Yeah.
Okay.
The misreporting at the bottom, that doesn't raise any revenue. It's a business.
I agree with that. I agree with that.
VAT, that's a solution.
100%.
Well,
Or everybody move to Scandinavia.
I think it was Larry Summers who said that, the VAT, Republicans should like it because it's regressive, and Democrats should like it because it raises a ton of money. When in actuality, Republicans don't like it because it raises a ton of money, and Democrats don't like it because it's regressive. But it would.
That's a Michael Greats proposal from 30 years ago. Yeah, it's not going anywhere.
So, I'm just gonna say on that note, thank you everyone for joining us. First, I just want to thank our speakers, David Splinter and Anmol Bhandari, but especially David Splinter because he traveled here from DC and Anmol just traveled here from Hanson Hall. So thank you. We want to thank all the students and staff who helped with this event. I especially want to thank Hannah Fairman, which is our new associate director, which is the most important position in HHEI. She's back there. And Whitney Oakes for their invaluable help in putting this roundtable together. And finally, I think a good number of them are here in our audience, our HHEI advisory board for their constant encouragement, counsel, and support. There is a reception just outside these back doors where we can continue this conversation. So please join us. And thank you again to our panelists.